I'm going to talk today about Grantor retained annuity trusts. I'm sure a lot of you have dealt with them in your practices or have clients that have set them up. Maybe some of you have set them up yourselves. But a Grantor retained annuity trust, or GRAT, is a trust that a client sets up. The client is the grantor and adds assets into that trust and retains the right to receive an annuity payment back from that trust. So Grantor retained annuity trust. And the reason why it's the best thing since sliced bread is because you can't lose setting up a GRAT. You can only win or draw. And I'll get into how that works and how the GRAT works and why that is. But to sum it up briefly, we have the Walton family to thank, the Walmart Waltons, because they won a case against the IRS that said that you can create a trust like this, a GRAT, that has no downside to it, where you can put assets into a trust that does not require you to use any of your lifetime gift exemption, or if you have no exemption left, does not require you to pay any gift tax when you set up this trust. Normally, when you fund a trust and you put assets into it, the value of the assets that you put into the trust is a gift, and that uses up your exemption. You put $10 million into a trust, it uses up $10 million of your exemption. But the way the GRAT works, and it's a statutory beast, how to design a GRAT is directly in the tax code. And so if we design it the way the tax code tells us to, the IRS allows us to subtract from the value of the gift the value of the annuity payments that you receive back, or the present value of those annuity payments. And the IRS tells us what to use as the present value. The IRS 75/20 rate, that's the discount rate. Right now, that's 4.6%, which is good because I did the slides in November and the discount rate was 4.6% then too. So all the numbers are the same in December, now that it's December 3rd, as they were back in November when I did the slides. So if we put $10 million in and we can structure the annuity payments so that the present value of those payments coming back to the client is $10 million, we haven't made a gift because we put in 10, we're taking out 10. And so the next question that a lot of people ask is, well, what have we gained then, right? We put in 10, we're getting out 10. Well, the hope is that the assets that you put into the GRAT will outperform the discount rate, that 4.6%. And if they do outperform that discount rate, there will be assets left in the GRAT at the end of the term. And at the end of the term of the GRAT, those assets will pass tax-free. So that's the goal here. We're trying to put into the GRAT assets that will return, and that's a total return, dividends, interest, capital gains, that will return more than the IRS discount rate. There are risks. The grantor needs to survive the term of the GRAT in order for the GRAT to be successful. You should assume, although there's some complex provisions that tell us how to calculate how much of the GRAT would be included in your estate if you die during the term, but you should assume that everything is taxable in the grantor's estate if the grantor doesn't survive the term. If the assets underperform the 4.6% discount rate or whatever it is when you set it up, then the grantor is going to get all the assets back. But so what? The grantor would have had those assets anyway had the grantor not set up the GRAT to begin with. So if we have success, if the GRAT assets outperform the 4.6%, we have to figure out what happens to the assets at the end of the GRAT term. They can go outright to your children, they could go in trust for your children, they could go in a SLAT, a trust for spouse and children. The one real drawback to the GRAT strategy is it's not a multi-generational strategy. This is not a strategy that you're going to use to fund a dynasty trust that's going to benefit grandchildren and great-grandchildren and so on for 800 years in Connecticut or 1,000 years in Florida. It's not that type of a strategy. This is really working on getting assets down to the next generation tax efficiently. Again, if the GRAT is unsuccessful, so what? You haven't used any of your exemption. All the assets are returned to the client. There's no tax or investment cost. The annuity payments are not taxable from the GRAT to the grantor. The reason being, the GRAT is a grantor trust. So any transactions between the client and the GRAT do not trigger any tax consequences. I actually want to skip ahead a slide or two here and get to an example. So I can show you exactly what I'm talking about for a base model GRAT. So in this example, we're going to fund $10 million. It was done in November, 4.6%, 75/20 rate. That's the same in December. Total return that I'm going to assume for purposes of this example is 10%. And I'm going to do a 2-year term. So the GRAT is going to last only for 2 years. We're going to put the assets in. At the end of year 1, we'll receive an annuity payment back. At the end of year 2, we'll receive the last one. Anything that's left over will pass to the GRAT remainder beneficiaries. If there's nothing left over, everything comes back to the grantor. There's a taxable gift calculation. It's less than $1. So even if you have no exemption left, you're not going to pay much in gift tax at all. So here's a basic GRAT example, level payments. Apologies for the size of the type. I don't know if people can see that, but you have the slides in your materials. And one of the things that you see here, this is a basic example because the annuity payments remain level. So you put $10 million in, I've got 10% total return, it's split 8% growth, 2% income. The required payments are $5,347,000 a year. And what you can see is at the end of the year, or at the end of 2 years, there's about $880,000 left in the GRAT. That's the success of the GRAT that is passing tax-free to children or trust for children, trust for spouse and children. Again, we would encourage, because the GRAT's a grantor trust and we can do unlimited transactions between the grantor and the GRAT, I would encourage that the remainder beneficiary of the GRAT also be a grantor trust so that we can continue to do transactions between the GRAT and the grantor, or between the remainder trust and the grantor. So if I go back a couple of slides, I want to get into some of the nitty-gritty about GRATs and some of the more interesting strategies in and around the GRAT technique itself. So number one, sticking with grantor trust, the GRAT is a grantor trust. And what that means, just for people that don't have a lot of experience with grantor trust, is that the grantor is responsible for paying the taxes on the dividends and interest and capital gains that are earned inside the trust. So when we're trying to beat that 4.6% 75/20 rate, we're comparing a pre-tax rate of return because the GRAT gets to keep the full return. The grantor is going to pay the taxes. So that helps us beat that hurdle rate. And then I have on here preserve step-up and basis. Well, we know that anything that we own when we die gets a new basis. Eva talked to us about that. The new law preserves it. And so anything that we own when we die gets a step up in basis. But if we've given it away irrevocably and it's in a trust, it gets the same basis that it had in the hands of the grantor. And so if you're funding this GRAT with your NVIDIA stock that you bought early on and you've got a $5 basis and it's now at 190 or 200 or wherever it is today, ideally, you don't want your kids or the trust for your kids to get that stock with the $5 basis. You want them to get it with a stepped up basis when you die. And so at any time, the client can swap out, can take the NVIDIA stock out of the GRAT or out of the remainder trust and replace it with assets with higher basis. You could take it out for cash. So you've got now $15 million of NVIDIA stock in there. Here's $15 million of cash or bonds. Take the NVIDIA stock back. It's going to get a step up on the client's death. And now we've got full basis assets either in the GRAT or in the remainder trust. The fact that it's a grantor trust allows us to freeze the GRAT. So what if we funded it with NVIDIA stock and it's up 50% in the first 6 months? Well, I think we're going to have a successful GRAT because all we need to do is beat an average annual return of 4.6%. So we can freeze that GRAT. We can take out the NVIDIA stock and put in something else that's not as volatile, cash, bonds, whatever the client might have. And now we can lock in the success of that GRAT. And we can do that without any tax consequences because the GRAT's a grantor trust and the client can exchange assets with a grantor trust without any tax consequences. What if we have the opposite example? NVIDIA goes down 50% in the first 6 months. Well, now we got to live another 2 years with this GRAT. And by the way, 2 years is the shortest you can go on a GRAT. You can go longer, but you can't go shorter than 2 years. So what if it's down 50%? Well, we've got a long way to go in order for this GRAT to be successful. So why don't we swap that NVIDIA stock out now at a 50% discount from when we put in cash or bonds to lock it in. We know we're going to get them back over the remaining term of the GRAT because that GRAT's going to fail, so we're going to get everything back. And now we can start a new GRAT with that NVIDIA stock at a price and value that's 50% lower than we started the first one. Now we've got a much greater chance of success with that new GRAT. So the fact that the GRAT is a grantor trust allows us to do these strategies. We don't just go to sleep on the GRAT and let it run for its 2 years. We're constantly analyzing to say, okay, should we freeze it? Should we keep it going? And it's not just freezing winners, it's freezing losers too, so that we can have a better chance of turning that loser into a winner the next go-around. Segregate non-correlated assets or asset classes. If you think about it, most people, if they have diversified portfolios, those diversified portfolios are designed to reduce risk. Risk is not, necessarily the enemy of a GRAT, because if you have significant positions that might move in opposite directions of each other, yes, together they reduce risk and they'll reduce the volatility. But if you put them in separate GRATs, we like that volatility in GRATs. If we have NVIDIA and we have, say, Johnson & Johnson, those stocks aren't going to move in concert. They're not highly correlated. And so we don't want them in the same GRAT if you have significant positions because they might offset each other. One's up, one's down. We want the NVIDIA in one and the Johnson & Johnson in another. If they both are up, great, we're going to have two successful GRATs. But if one is up and one is down, they won't offset each other. And we can capture all of the upside of the stock that's up and not have the downside of the one that's down offset it. And so we want to set up different GRATs for different asset classes or different stock positions. If your client has significant positions, multiple, then you're going to have multiple GRATs. We have clients that are setting up 15 GRATs a year with their different significant positions. Another strategy I want to focus on is rolling GRATs. And that is, if a client has decided that they already have enough money and they're willing to effectively use this strategy as an estate freeze because they don't want their estate to keep growing, because they're in a partnership, anyone with a taxable estate is in a partnership with the government. The government is basically rooting for your portfolio to do well because they're in for 50%, roughly, combined state and federal. And that's 50% of all the appreciation. If we are using a GRAT, the government's in for the appreciation up to 4.6%. We're cutting them out as a partner for any returns over and above the 4.6%. So if the GRAT strategy is something that the client's already decided they like, we want to keep using it. At the end of year one, when that $5.3 million annuity payment comes back, we want to put it into a new GRAT. And when the second payment comes out, we want to put that into a new GRAT. So this is kind of a confusing chart, but GRAT funding is today. You're funding GRAT 1. When you get to year one, the first annuity payment has to be made. Instead of just taking it and sitting on it, we're going to put that into GRAT 2. At the end of year two, GRAT 1 is going to terminate. We're making the second annuity payment. That's going into GRAT 3. And then the balance is going into the GRAT Success, the remainder beneficiary vehicle. The second payment out of GRAT 1 is also going to fund GRAT 3. And we're just going to keep rolling. As these payments come out every year, you just keep putting them right back into another GRAT. And what's going to happen is markets are going to go up and markets are going to go down. But if you stick with the strategy, you're going to have some that fail and you're going to have a lot that win, because over time, markets seem to go up. If I go back to the example, though, there's more that we can do in the structuring of a GRAT. Some clients really want to minimize the duration of a GRAT because they want to capture even smaller periods of time than just 2 years. They want to bring it all the way down to 1 year and minimize each time period to capture the volatility that the markets would experience or that the individual positions would experience over a shorter period of time. And so what a lot of people do is at the end of year one, when the first annuity payment is made, they'll freeze the GRAT and they'll take all the stock that was in that GRAT and replace it with something less volatile, whether it's a winner or a loser or a draw, but they'll just swap it out. And so now GRAT number 1 is basically frozen. We know exactly where it's going to be. Maybe it's in treasuries, it's going to get 3.5% or 4% or whatever it is right now, but we're going to take all the NVIDIA stock out and put it in GRAT 2. So we effectively just captured that 1 year return for the NVIDIA stock because we swapped it out of the GRAT. We're going to put it now into GRAT number 2. That can be hard for clients that maybe don't have a lot of cash or assets that are good for freezing a GRAT, because if you look at the beginning principal, the first or second column and second row, year two, that $5,660,000, that's how much you'll need to freeze the GRAT in this scenario. Some clients don't have that much lying around. So especially if we're going to be doing this every year, they're going to get that cash back over the next year because it's only a 2-year GRAT. So when the annuity payment is made, second annuity payment, they're going to get that cash back. I'm going to skip to example 3 here. We can actually set up a GRAT, and I say we can. It used to be that we were a little nervous to do it because not a lot of people set up GRATs with decreasing annuity payments, even though there's always been a regulation that allows and shows that you can set up a GRAT with decreasing annuity payments. People were a little skittish about it, even though the existence of that reg, but recently there have been a lot of proposals to disallow decreasing annuity payments. The Biden administration had it when they came in, and then Senators Wyden and King came up with their very creative GRATS Act, Getting Rid of Abusive Trust Schemes Act. All these proposals were trying to prohibit decreasing annuity payments. But a decreasing annuity payment in the structure of the GRAT makes it much easier to shorten the duration. And so in that example, the annuity payment decreased by 80%. So if you set up a GRAT and you front load the annuity payments, you have a lot less. If you look at that same beginning principal balance in year two, you've got a lot less left in the GRAT that you need to freeze because you've taken out 80%, roughly more than 80% in the first year, and you have to take out a lot less in the second year. So now we've isolated and we've really gone a long way to shortening the duration of a GRAT. and capturing just 1 year's worth of volatility and doing it in a way that doesn't require a lot of extra capital in order to get it done. You can also design a GRAT that has increasing annuity payments. Let's say you're putting in an asset that you're not going to do rolling. You don't want to take as much out as possible in the beginning. You kind of want it to run. Well, the longer it runs, the greater the benefit should be if you're outperforming the 75/20 IRS hurdle rate of 4.6%. And what's interesting is that in the case where the annuity payment is increasing, and by the way, you can only increase it by 20% a year. It can't go up by more than 20%, but you can increase it by up to 20%. If you just look at the results of this increasing annuity payment, where we have, what is that, $900,000 at the end of the GRAT, that's the GRAT success, and we compare it to the level annuity payments, which is less, $880,000, and then the decreasing annuity payments. The decreasing is actually the worst performing, which makes sense because the assets aren't in the GRAT earning longer. We would only do the decreasing annuity payments if the expectation was that we were either going to freeze the GRAT or we were doing rolling GRATs and taking that annuity payment out and putting it right back into another one. We wouldn't want to just do it and sit on it, because then you end up with the worst outcome out of the 3 possible scenarios. I know that was a lot to jam in. Sorry, I'm a little bit of a puppy talking about this because again, right, best thing since sliced bread, can only win or draw, can't lose.